Alrighty. So in today's video, I'm going to be talking about how to start trading options as a beginner. So if you're new to trading options, or maybe you haven't been trading for too long, or maybe you've been struggling to even be profitable when you're trading options, then this is for you, right? Because this is exactly how I would start all over again, right? If I was to start trading options from scratch as a beginner. Now, of course, I would assume that you at least have the basic foundation of options. That means you know at least what's the calls and puts, and then we will begin from there. So what I've done for this video is that I have laid out a number of steps for you to go through, and I wanted to keep things really simple, and it will give you the best chance of succeeding in options trading. All right, so let's get into the very first step. So step one, and that is to choose just one option strategy. Right? Too many times, many people come into options trading, especially, if they're just starting out, and then they are flooded with so many of these option strategies, they get so excited, right? They see one, they like it, they go for that one. They see another one, they like it as well, they go for that. And at the end of the day, you have like a mix of so many different strategies, and they get so confused and they don't get the kind of results, right? So one of the biggest traps that many beginners fall into when they first get into options trading is to trade too many option strategies at one time. Not only does this overwhelm you, but it also lets you feel very confused as to which one you should be using at which time. So instead of going for too many option strategies, what I'd like you to do is right now at the start, just choose one strategy to focus on, right? Just one strategy, stick with it until you've mastered it. And there's no reason why you cannot just choose one strategy and then be profitable with it. So you might be asking right now, so Davis, there are so many option strategies in the options trading world. Which one should I choose? So I'm going to give you a number of strategies down here, but I want you to just pick one, right? Just pick one out of this 5 I'm going to share with you. And you want to see which of the ones kind of suit your characteristic the most, right? So the very first one is the ever popular wheel strategy, right? So wheel strategy can be a good strategy to begin with because it's really, really simple, right? In the sense whereby you really only have to deal with just one option leg at any given time. So for example, the wheel strategy, how it starts off is by selling this cash secured put. Now remember, when you're trading the wheel strategy, the whole idea here, the intention here is to get assigned on the underlying shares, right? The underlying stock. That means to say, if the market actually comes into cash secured put, don't try too many things to try and save it or thinking you're going to lose money, right? Because the whole idea here is that this cash secured put is meant for you to just get the credit, and if it goes below, this is where you want to get assigned and get into the shares, right? So if it goes below your cash secured put at expiration, then this is where you're going to be long 100 shares. And then from here, very simple as well. You just have to find the right timing to sell the covered call. So the covered call, some people want to sell it exactly at where, they got assigned the 100 shares. You can do that. My preference would actually be to sell the covered call above where you get 100 shares. This way, if the market goes up, not only do you get the premium from the cash secured put and the covered call, you also get the capital gains, right? The difference from where you are long the 100 shares to where you are being called away from your covered call, right? So as you can see here, it is pretty simple, just one strategy at a time. Now, one thing about the wheel strategy though, when considering whether this is for you, is that number one, you have to be pretty good at the stock selection, because if you were to get assigned on the shares and if the stock just continues to go all the way down and it never recovers, then guess what? You'll be stuck in a very long-term position, and the whole operation of this wheel strategy is just not going to be a profitable one, although you're just getting the premium, right? So stock selection is very important. Now, the other thing is that it's pretty capital intensive, right? So who is this for? It's for you if you have quite a bit of capital and you don't mind holding on to shares for the mid to long term. So how exactly do you trade the wheel strategy? Well, that's a good question, because I have already created a ultimate wheel strategy training program just for you. It's about 2.5 hours long. So go to my channel and search for this, right? The ultimate wheel strategy course for beginners. I've packed a lot of information inside here, especially also how I trade the wheel strategy, my own variation of the wheel strategy. So definitely go to my channel, go and watch that. All right, the next strategy is the bull put spread. So from here on, we are getting into what I call the income strategies. And by the income strategies, what I just mean is that our aim here is really to just trade the options without getting assigned on the shares, right? So no getting into the shares as much as possible. So this is also where you really need to know how to manage it when your position really goes in the money, right? Sooner or later, if you trade long enough, this scenario will happen. You just need to know how to manage it. So this is the bull put spread. It's a pretty simple strategy. It is the bullish version of the credit spreads, right? So for the bull put spread, you really want the market to either go sideways or go up, right? In this case, the typical win rate of a bull put spread is around 70% and above, right? It really depends on how you choose this short put delta. So who is this bull put spread for? So it's for you if you're bullish on the underlying that you choose, right? So there are a few ways for you to select the stock. And if you want to know exactly how you can choose the right stock for trading the bull put spread and also the mechanics, how to manage it, then I have a full trading course for you that is about 5 hours long, right? I call it the most in-depth credit spread training for beginners. So if you want to learn how to trade the bull put spread really efficiently and also consistently to be profitable over the long term, then you definitely want to watch this video here, right? So I label it the only credit spreads trading course you ever need, 5 hours long. Go to my channel, look for that and watch that. So the next one is now the bearish version of the credit spread, and that is the bear call spread. So the bear call spread basically is just the exact opposite of the bull put spread, and the typical win rate should be also very similar. Now, this also really depends on the underlying that you choose. If you choose an underlying that is very fundamentally strong, right? If the market keeps going up over the long term, then of course you're going to be at a disadvantage when you're trading the bear call spread. So for this, you also need to know how to choose the right underlying to trade the bear call spread. So who is this for? So this is for those who are much more bearish on the overall market, or at least on the underlying that you choose, right? Some people will look at the general market and they'll say, oh, it's really overbought right now. The market is already so high. If you're one of those people, then you might want to pick your spots to actually put on the bear call spread, right? To trade in towards the downside. So if you're this kind of person, the bear call spread will be suitable for you. And again, exactly how do you pick the mechanics of the bear call spread? What kind of underlying that you choose? I cover it inside this same video as well, the only credit spreads trading course you ever need. So definitely, again, go over to my channel, search for this. You will find a very in-depth training on credit spreads. Now, the fourth strategy is the iron condor. So this is where we get into many leg strategies, right? This is what you call a multi-legged option strategies, where there are 4 options that you really need to know how to put on, right? So the iron condor is a neutral strategy whereby you don't want the market to go too far up, you don't want the market to go too far down, you just want it to stay within this range over here, right? As long as it stays somewhere within the range, then you'll be profitable, and it can be profitable over the long run, again, really depending on how you trade it. So who is this for? So if you're the kind of person that, you don't want to pick a direction and you just want to play the edge, whereby the realized move is most often the time lesser than the expected move. So if you're wondering what this is, right, this is actually an edge that we have in options trading, right? It's a hard edge that we have that you can utilize it to have, positive results over the long term, right? Again, it's always over the long term, not just over a span of like 5-10 trades. Really, you want to look for over 100 trades for this edge to eventually play out. So this is what we call the edge in options, realized move lesser than the expected move. So if you're somebody that just want to trade the expected move, you don't want to bother about, seeing whether it's too far up and then you want to short it, or the market has gone too far down and you want to go long, then you go for the iron condor. And again, I have a in-depth training on the Iron Condor on my channel as well. Again, I call it the most in-depth Iron Condor training for beginners. It's about 4 hours long. If you haven't watched it yet, definitely go to my channel and you'll learn exactly how to construct it, when to put it on, and also the underlying that you should choose when you're trading the Iron Condor. Now, last but not least, the final option strategy that you can choose from would be called the put broken wing butterfly. So the put broken wing butterfly, as you can see, is this structure over here. So what it essentially is just a put credit spread that is financing a put debit spread, right? So this put broken wing butterfly has a pretty high win rate. Oh yes, I forgot to mention about the win rate of the Iron Condor. The Iron Condor typically has a lower win rate compared to the credit spreads, right? Mainly because you have, you're being cornered on both sides in the sense, right? You're being caged in or boxed in on both sides. So your win rate is slightly lower at around 65%. Again, really depending on how you choose the deltas. Now, but for the put broken wing butterfly, this is where you can have the highest win rate out of the 4 income strategies that I've shared down here, right? So these 4 are the income strategy. So the put broken wing butterfly typically can have a win rate of above 80%. Certain cases can also go up to 90%. So this strategy down here is what I call a pretty defensive strategy, in a sense whereby we actually do want the market to come down, right? Because the place where you're going to have the most profit really is if the market comes down to these 2 short puts down here. When you pin this short strike down here, this is where you're going to make the most of this option strategy. So this is where, if the market goes up, you do not lose any money because you still have some minimum credit for you to earn. But if the market comes down, this is where you're actually looking forward to it getting into what I call the tent. So if you take a look at the put broken wing butterfly, it will look something like this on the P&L graph. And let's just say maybe the market is somewhere around here. This is where the market price is. And as you can see, we do want the market to come down. And this is where the pinnacle of the tent is, right? I call this shape down here the tent. So you want the market to come down to actually be able to make the most out of this option strategy. So who is this put broken wing butterfly for? So if you want to trade an omnidirectional strategy, and by that, what I mean is that there are multiple ways for you to make profit in this strategy. Is that if the market goes up, you still get a minimum credit. If the market goes sideways, depending on how you construct it, if it goes below this long put, you're going to have more than the minimum profit. And if it goes down as well, you're going to be in a bigger profit as well inside the tent. Now, of course, we don't want it to go way down below our protective long put down here, because if that's the case, then we can possibly lose money as well. So remember, there are no strategies that you're going to get like 100% win rate, at least not inside this income strategies where you're just trading in options, but it's a pretty high win rate. So if you want an omnidirectional strategy with a pretty high win rate that aims to capture profits if the market goes down, then the put broken wing butterfly is for you. So there we have it, right? You have the 5 option strategies down here. I want you to just pick one of this that you think is going to be most suited to your characteristic, the way that you like to trade, and then master it, right? Just stick with it. So how do you trade the put broken wing butterfly? So I've created a video on this. So I label it the safest option strategy for beginners. If you haven't seen it yet, definitely go over to my channel and watch this video, because I'm going to explain exactly how you can put this on. Okay, so this is for step 1. Now, step 2, this is where you start to create your watch list for the strategy that you have chosen. So remember, each strategy is going to be pretty unique, and I'm just going to give you a guideline as to how you're going to choose the underlying for each of the strategies, right? So basically, you want to look out for the one that you have chosen, because each of these strategies kind of rely on slightly different types of underlying to trade, right? Which one is suitable? So remember, strategy is one thing, right? But you need to pair the strategy with the right underlying. Only when these two pairs well together, then you can have a positive result over the long term. If you have the good strategy, but you have the wrong underlying, then guess what? No matter what you do, it's not going to be profitable over the long run. Okay, so here are the stock selection for each of the strategies that I've just shared. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So first of all, let's begin with the wheel strategy. So what kind of stocks should you be choosing for the wheel strategy? Well, in my opinion, it would be fundamentally strong stocks. Because if you think about it, the wheel strategy predominantly is actually a bullish strategy, right? Because if you sell the cash cow put, your aim is really to get a sign. Let's say you don't get a sign, you get the premium, that's fine. But if you trade it long enough, sooner or later, the market will come down and then you're going to get a sign. Now, this is where you get into the shares. So the stock itself has to go up. If it continues to go down, no matter how you keep selling the covered call after that, you're still not going to have the whole position become profitable. So definitely fundamentally strong stocks, right? And I've already given, an exact detail of how I choose this fundamentally strong stock in the wheel strategy trading program, right, which I shared earlier. So definitely go and watch that. So for the wheel strategy, choose fundamentally strong stocks. Now, what about the bull put spread? So the bull put spread is bullish strategy. We want the market to go up. So same thing as well. I would also suggest to trade fundamentally strong stocks and also the broad-based index ETFs, right? Because if you were to trade the broad-based index ETFs, right, mainly the US broad-based index ETFs like the SPY, QQQs, RWM, Diamond, so on and so forth, these are all what I call the positive drift vehicle. That means to say the market wants to keep going up in the long term. So if you want to trade the bull put spread, it really helps that you trade an underlying that at least in the long term has a greater chance of it going up than, having it no idea what it does, right? It goes sideways or go down, right? For example, if you trade stocks like AMC, then good luck to you, right? You're in for a rude shock if the market suddenly plunges. So bull put spread on fundamentally strong stocks and index ETFs. Now, what about bear call spread? So remember, for wheel strategy and bull put spread, we want the market to go up. So that is why we generally trade, underlyings that want to go up over the long term, fundamentally strong stocks, broad-based index ETFs. But what about bear call spread? Bear call spread is a bearish strategy where we want the market to actually go down. So this is where I wouldn't suggest to put on the fundamentally strong stocks or maybe even the index ETFs, right? So it really depends on how you want to trade it. But basically, I would say non-fundamentally strong stocks. Index ETFs, you can, but you really have to pick your spots well. So if you want to play it safer in the sense whereby, you want the bear call spread to kind of work out, then probably you can go for those kind of stocks that is not fundamentally strong. That means there is no sense of whether is it going to go up over the long term because they have it's a profitable company. Well, most likely you're going to choose companies that are not profitable because this way, that the stocks can go sideways. So there are a lot of choices for this, right? In this case, bear call spread can be virtually most of the stocks in the stock market, because most of the stocks in the US stock market, well, a lot of it are not fundamentally strong stocks. So these are the candidates for bear call spread. Now, what about the iron condor? So for the iron condor, remember, we want to trade the expected move. And for this, I really want to choose an underlying that is not too volatile. I don't want it to keep moving all the way up or all the way down. Especially, I don't want to get into those situations where there's an earning coming or some unexpected news of the company that will make a very huge move in the underlying. So for this, I would suggest index ETFs, because index ETFs, you don't have to worry about earnings. At the same time, the volatility is generally lower compared to individual stocks because you have a basket of stocks, right? Sometimes you can see certain index ETFs that carry an underlying, let's say a single stock, and the single stock has a huge move. Maybe it moves like 30%. If it moves 30%, if you take a look at the index ETF that actually carries it, right, the broad-based ones, chances are that it may not even move that much, right? Maybe even less than 1%. So these are very good for iron condor because in the first place, we are only trading the expected move. We don't want the market to move that much. Now, finally, what about the put broken wing butterfly? What kind of underlying should you choose to trade the put broken wing butterfly. So for the put broken wing butterfly, I would suggest to trade the cash settled index options because this is a pretty slow spread, and at times you can actually hold all the way to expiration. Now I know some people would prefer to cut it out at 50% or 25%. This really is up to you, right? You can definitely do that, but I think that the cash settled index options would be a good way to trade the put broken wing butterfly, because we actually want the market to come down to where our short put is. And if you were to trade this on those index ETFs or individual stocks, these are American style options, then you could possibly get assigned on the shares even before it reaches expiration, right? So this is something to really keep in mind of when you're trading the put broken butterfly. Okay, so this is step 2. Now let's get into step 3. So for step 3, this is where you want to set up your chart, right? Get your chart ready to start trading the option strategies. So for me, I like to keep my chart very clean and simple with at most just 2 indicators, right? As you can see over here on the right hand side, I only have 2 indicators on, right? You have the moving average, which is the purple line on top, and then you have the stochastic oscillator, which is below. So the moving average, I don't really use it at all to, determine whether the market is time for me to enter into a certain trade or not. Rather, the moving average, I just put it on just to have a general sense of the direction, right? Is it generally trending upwards or downwards or going sideways? But moving average is not that very important, especially when we're trading the options trading for slightly longer term. So you can choose to put on the moving average if you want to. If you want to, then just go for like the 100 EMA or SMA, right? That's pretty much what I put on. And finally, for the last indicator would just be the stochastic oscillator or the RSI. So this is just a way for us to identify either overbought or oversold conditions in the market. And this would really help us time the entry much better for the strategies that we are using, right? Not all of them we necessarily have to use it, but for most of them, right, this can be a helpful tool, right? Remember, it's just an indication of the underlying market condition. Doesn't mean that it's guaranteed it's going to work out all the time, right? So for example, if the market is oversold, it should go below the line. It lets you at least get into the strategy whereby, there's a higher likelihood the market will go up than it continue to go down, right? So for this oversold reading, you can put on bullish strategies. For example, the wheel strategy would be one of them when you're putting on the cash account put, and also the bull put spread, right? You could also, optionally, you could also use it for the put broken wing butterfly, right? So these are ways for you to identify the condition of the market. The next one is the overbought. Now the overbought, now of course, this will be where you use the bear call spread because you want it to be a bearish signal where you want the market to go down. So this is where you look at the indicator to see if it's overbought, right? Then you start to look for potential setups or entries for the bear call spread. And the other one would be the cover call for the wheel strategy, because once you get into the stock, and some people want to actually hold on to the stock, right? The shares. As the market goes up, you can wait until it's overbought and then you sell the cover call. Right, this way, if the market is overbought and you sell the cover call, there's at least a greater likelihood for the market to come down after that. You earn the cover call, your shares still being held in your account, it doesn't get called away. Now, what about for the iron condor? So generally for the iron condor, we don't really need the stochastic indicator whatsoever, or even the moving average, because we are purely trading the expected move. But in certain cases, you can actually just see if the market is neither overbought or oversold. Then this way, somewhere in the middle, you can consider to put on the iron condor. Now, of course, not necessary for you to do that, but you can do that if you want to. So this is just how I set up the chart. As you can see, very simple, very clean. Please don't put on like 3, 4, 5, 6, 7 indicators that you get so confused, no idea what to look at, right? So this is step 3. Let's move on to step 4, which is the most important one out of all the steps that I mentioned here, if you want to be able to trade properly, and that is to plan your exit scenarios. The biggest mistake that many people make when trading options is not planning their exit scenarios. For example, many times when they get into the trade, they have no idea what they're going to do if the market is going to move against their positions. Most of the time, when they enter into the position, they just look at, oh, this is how much money I can make. And they only think about the scenario whereby it works out for them. But when the market makes a very big move against them, right? For example, recently we had the unwinding of the yen carry trade, and that shocked a lot of people because there was a huge move. And because you didn't plan for it, or for those people who didn't plan for this exit scenario, they were lost, right? They have no idea what to do and they panic and they made a lot of mistakes. So this is where you really need to know what your exit scenarios are before you enter into a trade, right? After you enter into a trade and then go with the, thinking that, oh, I'll just wait until it gets there, then I'll think about what to do, then that's going to be too late, right? Remember, this is your real money at stake. So you want to plan properly before you enter into the trade. So planning your exit scenarios mean to be 100% fully prepared for wherever the market goes, so you know exactly what to do when it happens, especially the worst case scenario. Now, while we cannot control what the market does, the market will do whatever it does, we actually kind of already know that the market can go only a few places, right? So imagine this is the market. And let's say, for example, you have a bull put spread on. Let's just say you have a bull put spread on. Now, this is time where you already need to know exactly what you're going to do regardless where the market goes, because there are only a few places it can go. It can go all the way up, it can go sideways, and it can go all the way down. Now, given based on this bull put spread strategy, these two are the easiest to manage, right? Because most likely you should be in a profit, and also depending, right, if the market goes sideways, how far into the DTE it is, right? But it's very simple to manage for this. Now, the real issue comes when the market really makes a big move and blows through your put credit spread. This is where a lot of people panic, not sure what to do. You should already have a plan for what to do when this happens, or rather if this happens. When this happens, then once you got a proper plan, execute it. There should be no emotions involved. It should be very objective. So when you already know the worst case scenario and you accept it, then guess what? You're not going to really feel stressful at night, worried at night, because you already know that that is a possible scenario and you already accepted the risk, right? If you get into a position, right, get into a situation where you can't sleep at night, you wake up in the middle of the night feeling so stressed, it just means one of two things. Number one, you didn't listen to me. You didn't follow this step 4. You didn't plan your exit scenarios because, when the market makes a big move, you feel so shocked and you didn't expect it to happen, right? That's number one. Number two, you're trading way too big for your comfort, right? That is why you look at the P&L. And by the way, staring at it doesn't actually help, right? A lot of people like to just stare at the P&L and just hope, please go back up. But as the negative goes even deeper in the red, it becomes a bigger number. This is where people get so affected emotionally. So this is only one of these two reasons whereby, you can feel so stressed. So if you plan your exit scenarios properly, you accept the worst case scenario that you have planned out, then you shouldn't be getting yourself into a situation where you're surprised or you cannot rest well at night. So you have to plan out every possible scenario that can happen after you enter into a trade. For example, what will you do if the market goes up? What will you do if the market goes down? What will you do if the market goes sideways? What will you do if your strikes get tested? Where will you take profit? Where will you cut loss? Will you roll? If so, how will you roll? Where will you exit? So all these questions you must ask yourself and be really prepared to have the answer for this before you actually enter into the trade. So this is step 4. Now, once you've already completed this, you've already planned out your exit scenario, then this is where you can begin with the demo trading. Now, I know that with demo trading, you don't really feel that involved in it because it's not real money, and a lot of people don't really take demo trading seriously. But I'll say that if you can get into demo trading, definitely do it first, right? Because while demo trading may not necessarily reflect your actual trading performance, right? Psychological wise, emotionally wise, as well as the feels, right? The feels of the trades may not be very accurate as well, right? But what it does is that it gives you the chance to practice putting on the trade until you're familiar with the platform and also how you construct the trade. Because you will be surprised, right? Many people start trading live and they realize after they put on the trade, they constructed it wrongly, right? Maybe they put on the wrong strike, or maybe they enter into a trade that looks differently from what they thought it should be, and it makes all these mistakes. So when you do the demo trading and you practice it over and over again, it at least helps reduce the chances of making mistakes when you start trading live. Remember, the market will be there forever, right? So you have many chances for you to keep putting on the trade. The most important thing is that you do not make the mistakes, or at least reduce the chances of making the mistakes when you start trading live. Otherwise, it will be a very painful lesson which can be avoided if you had already done proper practice or enough practice through demo trading first. So only after you've done enough demo trading, doesn't have to be that long, right? Doesn't necessarily have to be a year or months. It could be after a number of trades and you feel confident, then you can move on to step 6, which is start trading live. And I would suggest to trade with the smallest size first. So once you feel confident enough to place the trades, knowing how to construct them properly, and you know how to send the order in, you can start trading live. But start off with the smallest size possible. There's just one contract first to just get a feel for the strategy and also understand your psychology and emotions, how it's involved when real money is at stake. Because many times you will see that, you have a plan, right? Like I mentioned, you should plan out your scenarios, your exit scenarios. But when it's time for you to actually execute it, you suddenly realize you cannot execute it because of a few things, either because of greed or for fear. Usually it's one of these two, right? Either greed, you want to take a little bit more, so maybe you don't want to exit, and then all of a sudden the market turns against you. And for when you're supposed to actually get that profit, all of a sudden it becomes a loss. Or fear, right? Fear could be also because, the market has gone down and then maybe it's not time for you to cut off the trade yet, but you fear of losing more, you quickly cut off the trade and you end up with, could have possibly become a winner. So it really comes down to your plan. If you have a proper plan, just stick to it, execute it, all right? And then next, put on enough trades until you feel confident you're ready to size up. So as you can see, there's a real proper sequence for you to do things so that, slowly you adapt to each stage, right? You start off with the demo first, put on enough trades until you feel confident, then you start trading live, but start off with the smaller size. Then you start off to put on a number of trades until you feel confident enough. Then you start to gradually increase your size through proper position sizing. So once you place enough live trades with the smallest possible size, you can gradually size up over time with proper position sizing. That means proper risk management and money management. And also it helps to keep a journal and trade log to monitor your trades and progress, because it can reach a point whereby, if you're not doing well, or maybe some of the trades you feel is not working out as you have planned, you have a journal, you have a trade log to go back to see, what you have done. It really helps, right? Especially if you were to also, journal what your emotions are going through as you execute the trades, right? Sometimes you will find some really great insights that can help you become a better trader in the long term. So these are the 7 steps. So let me just go through this summary again. So step 1, choose one strategy. One strategy, more than enough at the start. Master this, trade this until you've gotten very good at it and it's profitable. Then you can move on to the next one. But at the start, just choose one strategy. Step 2, create your watch list. So remember, strategy has to work well together with the underlying. So you have to choose the right underlying for the strategy that you're choosing. Step 3, set up your chart. Clean and simple is the way to go, at least for the way that I like to trade it. Step 4, plan your exit scenarios. Again, very important step. Make sure you've got this down well before you enter into trade. Step 5, get into demo trading. Step 6, start trading live, small size. And finally, step 7, gradually increase your size to your full size through proper position sizing. All right, guys, so this is exactly how I would start trading options all over again if I were to start from scratch. So if you too would like to follow in, the way that I trade, my footsteps, definitely go through these steps and let me know how you do. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.